Our first session, as I've mentioned already this morning, is led by someone who knows the Unimutual model better than anyone, our CEO, Geoff Henderson. Geoff brings deep expertise in risk, resilience and mutual management, with a career grounded in understanding how organisations can build long-term stability, value for the members. In this session, he'll unpack what makes Unimutual model uniquely robust and why it continues to deliver for members year after year. He will also provide an update on Unimutual's current financial strength and share a look at the strategic initiatives underway to enhance member value into the future. Please join me in welcoming Geoff Henderson to present a model built for members, stability, value and confidence.
Thanks, Meredith. Good morning, everybody. How is everyone this morning? I must admit, when I got back last night to the hotel, I got to the door, I looked at the lifts and I just kept walking because I could see a growing group at the bar and I just thought, don't look, don't look, don't look. Just keep going, you'll be all right. When I got to the lift, Tobias was there and Tobias said he did exactly the same thing. So hopefully everyone had a good night. I thought the food was outstanding. I thought the company was outstanding. Is Tony Goodman here this morning? Tony, thank you for the entertainment last night. It was wonderful on our table. So thank you for that, and also congratulations once again to all those who picked up Unimutual Excellence Awards, and thank you again to the Member Reference Group who work so hard on behalf of the membership. The work that they do really helps guide us in making sure that we remain relevant and aligned to the higher education and research sectors. I want to thank the team, and no doubt we'll thank them again later on today before we wrap. But this is a 12-month commitment that the team put into putting on a conference like this. And to Christine, particularly, and the member services team and the broader Unimutual team, thank you to everyone who's had a contribution in putting the agenda together, organising this great facility, and the logistics of getting everybody here. Because as we speak, logistics are changing, flights are changing, weather's coming in all parts of the country. So the team are keeping an eye across everything that's happening with flights, and if there are changes that happen, they'll let you know how that may impact. But I'm hoping to get home at some stage tonight. I'm not sure that's going to be the way. What I would offer in this session, for those who have attended previous conferences and know me, I'm always happy to take questions on anything. So if you've got any questions on any topic to do with Unimutual, please feel free to pop it into the app. And if it's not covered off in today's presentation, I'll make sure we leave time at the end. But please feel free to ask any questions, and we'll cover those. But what I will do as we go through the presentation today is stop, at the end of each little section and ask if there are any questions. So we've got the microphones there for any questions you've got. But if you don't want to use a microphone, just want to pop it into the app, that's fine too. But don't restrict it to just this presentation. If you do have a question about the mutual, I'm always happy to answer it as best I can, or reserve the right to say I'll come back to you if it's something that I don't have the answer on. So stability, value and confidence. If I look at where we've been, 35 years now past, we're in our 36th year. That's a picture of our inaugural annual report, and it shows the membership at the time from a director's perspective. And you'll note 35 years, 36 years on, University of Queensland is still with us, University of Tasmania and UWA are with us, as well as a number of other organisations who are at the 35 or 36 year mark. It's a fantastic history to have, and you can see one of the original logos, Unimutual Protecting Wisdom, and of course the more familiar, more recent copy of it. This was part of a presentation that I gave to a prospective member over the last couple of years, and we talked about the fact that we were set up in 1989 for a purpose, and that was off the back of the liability crisis that existed in the market. And the higher education sector and research sectors at the time struggled to get the coverage that they needed at an affordable price. And so that was the rise of a number of mutuals at that time. Civic Risk Mutual in the local government space, Unimutual for universities and research, Capricorn Mutual for the motor trade. A number of mutuals set up at the time. And those pressures still exist today. I would never want us to think that that was a thing of the past, because it actually is an ongoing issue with sectors. They come and go and fall in and out of favour, depending on the exposures, depending on the coverage types, depending on the loss experience. But the important thing for our mutual is, we're here for you, because that's the only reason we exist. So we don't have a choice of are we here or not one day to the next. We're here because you want us to be here, and we really appreciate that support. So today I'm going to cover off, as I normally do, a bit of an update on what we've delivered. And I thought 3 years into our 5-year strategy, I'd cover off a few of the things that we've delivered over the last 3 years. I wanted to do a bit of myth busting, and I'll talk about that in a little while, but the opportunity to maybe get some of the questions out on the table and encourage where we can, to try and bust some of the myths, because as I travel around the membership, I hear lots of great things, and also hear some questions that pop up that are a bit unusual. And I think it's important that we're transparent about things, and we can bust some of those myths that aren't true and clarify some of the things that are. A couple of quick case studies just to show what's been happening in the mutual from a loss perspective and how we respond to those and are resilient around those. Looking at 2026 announcements, the things in year 4 of our 5-year strategy and what you can expect from us, and questions at the end. But as I say, I'm happy to pause on the way through as we go section to section. So the journey so far, start of our 5-year strategy, we created a new vision, a new purpose and a new strategy. And our vision is to stand beside the higher education and research sectors, protecting you as you deliver benefits to the community. And we deliberately chose the words beside. Yeah, we're not on top, we're not below, we're not under. We actually walk side by side with the sector to ensure that you can take the risks that you need to benefit our community. In terms of our purpose, we harness the collective expertise and experience of the sectors around risk protection and risk prevention. And a key part of that is the conference here, where we're bringing together a group of people not to be lectured to, but to share ideas, share thoughts peer-to-peer, and really drive collaboration across the sector. And we see our role as being crucial to being able to bring that together. And our strategy, it's too small to see, but we've got a 6-pillar strategy that we are planning or are delivering on over this 5-year period. Members first, and it's the first pillar, and it just reminds us every day that we're here for you. Capital strength, which is about our financial resilience over time, and quite a bit of today's presentation is about that. Market connection across the higher education and research sectors, but also market connection internationally with like-minded organisations, so that we can learn from that as a mutual, and we can share in that knowledge not only here in Australia, but what's happening internationally around insurance, higher education and mutuality. Sustainable growth. It's an area that we want to grow for the right reasons. We don't have corporate targets that we push quarterly budgets, and it's fantastic to be in an organisation that doesn't have that. Growth comes for the benefit of the membership, and the more members we can bring in, the more knowledge we bring in, the more that we can share with each other from their experiences and their learning. So growth is important, but it's only important for the benefit of the organisations in this room today. It's quite a distinct difference that organisations push for growth in the commercial world because you want growth, you want more profit. Well, that's not a driver of ours. We want more members for the right reason. Manage the cycle. I talked about this a couple of years ago now in Hobart, was Yeah, the insurance cycle generally goes like that. We talk about hard markets and soft markets with reinsurance pricing. And our intention at Unimutual is, as best we can, to provide flat pricing over the long term. Now, it's a mighty goal, mighty aspiration to get to that point. But if we can stop this cycle for our members and bring it to more like that, it gives you more certainty when it comes to time for budgeting and a long-term view, because we do think in terms of decades rather than quarters around things. And the last one's dynamic organisation. It's making sure that we're the most efficient, most up-to-date, most responsive and resilient for the membership to ensure that we continue to deliver on your needs and change as your needs change. And even in the past nearly 4 years that I've been here, the higher education and research sector has changed quite dramatically, not only through the Accord, but through other pieces of work, other demands. Yeah, we all know international student loads, working from, studying from home, studying in person, quite a dynamic environment. And we need to adjust as you need us to adjust. I've stolen a quote. I'm a bit of a student of political speeches, not of politics itself, but I love a good political speech, whether it's Churchill or Reagan or FDR. Not too many Australians in there, I must admit, when it comes to inspirational speeches. But I pinched this one. Ronald Reagan's speech was that we're a nation that has a government, not the other way around. We're a nation that has a government, not the other way around. And I took that to mean, that as a country, they have someone to support and guide them. Yeah, government doesn't exist to run things, and then the people are secondary to that. So I turned that round. What would that mean for us? And the best I could come up with was, the Unimutual, we have members that own the mutual. Yeah, the mutual doesn't own the members. Having worked at a general insurer or general insurers for many years, there's a view of I own the customer. And that sense of ownership drives behaviours. But I'd like to think that the way we look at things is that as a membership, you own us. And you do. Every dollar, the $23.6 million in accumulated surplus we have in our funds to protect the mutual and allow us to take the risks we need to do and to do our things, belongs to your organisations, because you've contributed to that over many, many years. So we're very conscious of that model and what that means. And it means that we're obviously very protective of the money we spend because it's your money. But we also understand that, yes, you are a customer of ours in the services we provide. You also own us. And as CEO, it's a wonderful thing that I don't have to think of new things to do because you tell me what to do. And that's what the member forum's for, that's what the member reference group is for. And when I come to see you, or the team come to see you out on campus, out in the research facilities, out on college facilities, we pick that information up and then we can come back and do something about it. So we're constantly reminding ourselves that you own the mutual doesn't own you. And it's a great model to be in, and it's why I'm passionate about our business and how we support the sector. So what do? We treat every member fairly and equitably, because that's what you expect of us. We understand members through in-person visits and revisits, because we never assume we know everything about you. Members have a voice, we listen and we act. And hopefully you see that through the feedback through member surveys and member forums, that when you ask for something, we will do our best to act on that and deliver on that. Members have representation on our board. Our constitution has a design of 60% membership representation on the board, which is incredibly valuable for the management to be able to ask questions of representatives from the sector about what the sector would want. Complemented by 40%, 4 directors who come from other disciplines outside, be it insurance, broader finance, or other sectors. We have the member forums and member reference groups. We plan over years, not just to the next quarter, not even to the next quarter. We're thinking about things 5 to 10 years from here, which is what you need and want from us. We connect internationally. We've got a great relationship with the Canadian Universities Mutual. We've got a great relationship with the Mutual in the UK. And even last week I was on the phone to an organisation in the US that supports insurance and insurance-like products, mutual products, for the higher education sector in the US. Because what happens in the US generally then ends up happening in Canada and the UK, and then eventually happens in Australia. So in a way, by talking to these organisations, we're able to look into the future to be able to talk to our membership and say, guess what's coming down the pipe? Anyone want to take a guess what the biggest issue on the rise in the US is, particularly in the casualty market? It's not abuse, although that is a big risk in the US. It's actually, would you believe, professional sports people suing universities for using their image from the time they played sport at the university. They're seeing a dramatic rise in these cases where their image is being used in the world of privacy and the world of protecting your IP and your image. Now, I haven't seen any of that in Australia yet. But do we think it will happen here, and when do we think it will happen here? We don't know. But by having that insight, that foresight to what's coming, helps us to be able to prepare our membership for what might be ahead, because we may want to think about, when we have our sports teams, our semi-professional sports teams, that maybe we want to include something about the use of image. So that only came up last week, so I haven't really had time to digest that all for the team. We work in the sector for the sector, and we take the risks that others feel less comfortable with. Originally we take the risks others don't want to take. And I think that was a step too far, because others will take the risk, but they will fill that unknown with premium generally. Or they'll restrict the cover, and then if claims happen, they try and exclude it eventually, or upcharge the premium. Our program's designed to take the risks that you want us to take because it's important to you and it's unique to you. And then what we do is the other risks, well, we then ask the reinsurers to take that where they're more comfortable. So it's by design, it's not by good luck that we are structured that way. So what do we do in 2022 to 25, the first 3 years of our 5-year strategy? New products, fine art, rare books and collectibles cover, which has been well received. It was driven by member request. We didn't think that the fine art cover within the property was appropriate and as optimal as it could be, so we created that new product. Pandemic cover has had some interest and taken up to provide cash flow in a COVID-19 style environment. We refreshed our PDS, and quite a big overhaul in the last 3 years, but we always look to refresh and update, as you heard from particularly Jade on Wednesday around some of the extensions of cover we're looking at. We offered increased limits for active assailant cover last year. Launched the member dashboards this time last year, which allows members access to their own data pretty much real time. The app updates at 8 o'clock every night. I love being able to sit out and talk to members, and I pull out the phone and pull up their data, and we can have a real-time chat about what it's telling us in terms of the history of your contribution payments, the history of your claims, where some of the claims are up to, the current status. So if anybody isn't aware of the app, please let us know. We can get you on there so that you can see your own data real time and to be able to use that in your reporting further up the line. We launched member surveys, and that's an annual survey that we do to provide that formal mechanism for feedback annually. Early renewal presentations. We give a heads up in July on what we think pricing might look like so that you can start to help set your budgets a bit earlier than we probably have in the past. And then the renewal terms going out early October so that you can get that time to really consider your options around retentions or different levels of cover. But of course, between July and October, a lot can happen. And our intention always would be to update you if things change materially, so there's no surprises on the way through. Additional services. So we've invested in risk services with the high value equipment register and also the research valuation work by bringing Glenn Mowbray in to complement the work that Simon and Greg have been doing over many years. But at the end of the day, we're here to make sure that when you need us, we're here for you. And in the last 3 years, our members have incurred losses of over $90 million. It's $90 million in the sector that we're supporting. And that includes the losses we know about and provisions for losses that we're yet to see. Things that we call incurred but not reported. Things that have happened but they haven't become material yet that we've seen, or we provision for incurred but not enough reported, where we've got a reserve, waiting to see it through, but then the claim grows as we learn more about it, and risk margins. So $90 million in the last 3 years alone. Over the last 3 years, we've paid $315 million. Now, that might seem a bit contrary. The $90 million are losses that happened in the last 3 years. The $300 million pays for claims, some of the claims that happened in the last 3 years, but claims prior to that. So you can see a lot of money going through there to support the sector. So what does this mean in terms of what we've delivered and how we've supported over the last 3 years? We've had 20% growth in our member numbers. It's been great. We haven't seen growth like this in the Mutual's history. We're promoting ourselves more. We're raising the brand profile because we want to find like-minded organisations to join us and share with us and grow. Because as we grow, we get bigger scale, which leads to our better ability to deliver services and get economic prices. Retained over $20 million in accumulated member services, and Andrew referenced that in his opening yesterday. The last 3 consecutive years, as the last 3 years would be consecutive, have been great. And I'll show a little bit later how the model creates that surplus. You know, it's not a mystery, it's actually fairly simple, and I'd love to share that with you. Member satisfaction from the survey at 95%, member trust at 98%. And I'm really proud of the trust scores particularly. It's great that we deliver a great service, and it's great that you provide feedback that you enjoy that service. But we're an organisation built on trust. And if we don't have your trust that we're doing the right thing for you every day, then we have a problem. So it's fantastic that we feel trusted in what we do, and we want to continue to keep that trust, and if possible, continue to be more trusted. 98% member retention by member numbers over the last 3 years, which is great, although I'd always love to keep the 2%. And look, for Service Excellence Awards, which I acknowledge is just recognition of what the Unimutual team do day in, day out for our members. So it's a really good story, and one that I'm proud of what we've been able to deliver over the last 3 years. So we're going to move into myth busting, and through a few discussions recently, I've come to the feeling that when you're the largest in the sector as we are, and when you deliver a good service that's valued by your members, you have a big target on your back. Because when others look for growth, they look for opportunities to get an opportunity in a sector, where are they going to look to target the business from? And it's going to be from the biggest. So what we hear periodically is stories that go through about why others might be a better opportunity. So I'd love to share a few of those myths with you, and I guess answer those questions, and talk about what I'd like your help with as we move forward. So I stuck in a photo, sorry it's a lot of my face, but those who know me know that I don't mind a selfie, particularly when I'm out on campus. And the team love getting out on campus, myself in particular, but the whole team love getting out to see our members, because we learn so much. And I remember the first time, if I could pick ECU for example, the first time I went to Edith Cowan Uni, and Cara said to me, "Geoff, you've got to go and see our science building." So I went for a walk to the science building, and she said, "There it is." I said, "Oh, very nice building." "Yep." And she said, look what's on the side. And it's the Southern Hemisphere's largest periodic table. And it's fantastic. If you haven't seen it and you get the chance, it's brilliant. And I could send that home to my kids and share that with them because they always ask, Dad, what do you do? And I can talk about it. But as we go out, we find out more from members, we hear more from members, and we can uncover some of the things that you need, but also some of the myths that persist. And some of them go a long way back from years and years and years ago. So we take that opportunity. The photo in the middle, that's Frank, the Kodiak bear from Macquarie Uni. And we had a team day out there. Macquarie very kindly hosted us on site out there, and we got to meet Frank, the Kodiak bear. And that was a great day. But it's good to get out to the research facilities, to the uni campuses, to the colleges, to really understand what's happening and what makes you unique. So I've got a couple here. First one we hear is, well, everyone gets the same rate. You're a mutual, everyone gets the same price. So because I'm so good at what I do and my risk management, why don't I get a better deal? Not true. No deal. Okay. Everyone has a different rate. All 60 members have a different rate that is charged. And that's because the rate component, for those who were here last year would remember, when we price risk, it's based on your individual risk. So it's based on your unique profile. Are you a university? Are you a residential college? Are you a research facility? Are you an admission centre? Are you a training organisation? Yep. Your rate is unique to your occupation. The next one, it is adjusted by your construction. Are you a heritage listed site? Older sandstone buildings with slate roofs? Are you a brand new city campus that's been designed to 2025, 26 standards? Are you a research facility that is fully sprinklered, sprinkler protected? So you look at the different areas. Natural catastrophe. Are you on a river? Are you on an earthquake fault line? Are you in a hail path? Each one of those factors is taken into consideration. And of course, claims history is factored in. Not that we're so negative that when someone has a claim, we hit them with an increase, but claims frequency is an indicator of risk. So we do take claims history into account when we do the pricing. And that's why you end up with 60 different prices from a rate perspective, and then each one, your asset values are different. So the price, the true dollar amount is different in itself. So there's no community rating. It's individually priced based on risk. And those that are working on their facilities to improve their risk get the benefit of that in pricing over those that may not be as proactive in managing your risk. Wording and coverage. We do our best to ensure that our wordings, our coverage is comparable, if not better, in the market. And we have the opportunity when we look at new members to look at what their current wording is, and then we say, well, how does ours stack up? Do we need to change? Is it contemporary? And that's where some of the changes come from. And again, Jade mentioned on the casualty side, the property side last year, one of our members brought up our approach to retentions on controlled environment, freezer claims. And based off the back of that, we made a change last year to that. So can I stand here at any point in time and guarantee that we have the best wording in the market? Well, I don't know what I don't know about our competitors. But what I do know is the members here who have brokers, those brokers very quickly tell us if our coverage isn't in line with what they're seeing in the market. And our members always have the option, either individually or through the member reference group or member forum, to bring ideas forward. And that's where the member reference group are really active, that they say, look, we like the cover, we understand it, but it doesn't quite work for us. Or we've had a couple of claims, can we make a change? So contemporary wordings are really important to us to ensure that when we're looking around the market, we want to make sure that we're covering the things that you need from us. The last one, shared limit, and this came from many, many years ago, well before myself, Tobias, Jade joined. There was a sense that we bought a policy limit, and then in an event you might not get paid out to your full limit, that it was somehow shared with other members. And it's absolutely not true. the protection that we offer you says something like 500 million each and every event for your organisation. So that's the cover that we offer you. It's not our mutual has protection for $1.4 billion and in a loss we hope it covers everyone and we'll share it around. There is a collective outside of Australia that I'm aware of that has that sort of arrangement, and they have unique circumstances and they can't get full cover for everybody. So they have that sort of arrangement. For Unimutual, we offer you protection for each and every event for you as a member. And you should feel entitled to be able to claim up to that limit if an event happens. Please don't have that event. I've had enough of large claims, in my career to see me through. But there's no shared limit, okay? You get a PDS, it has your protection limit, you're entitled to claim to that limit in an event. We factor in the mutual, if you have, and most commonly the accumulation happens if you've got a university that's got some colleges around it, we factor that in when we set our own protection behind the scenes. So that if you had an event at a UQ, we know that we've got half a dozen colleges around UQ, so we take that into account, that if a loss was to happen there, that we're protecting the mutual for that event. The last one I'll cover off today is around pricing. And I do like to cover pricing because I think it's an important one. I hear some great things. I hear mutuals don't work in a hard market, and then 12 months later, mutuals don't work in a soft market. But what you'll see over the last decade, over a decade, is through hard market, soft market, our pricing's been good. Last year in a softening market, we beat the average in the market. So I'm confident in our pricing, and hopefully you would have seen this in our half-year update, annual report and bulletins. It's a piece of work we did with Finity Actuaries to look at Unimutual rates since 2015-16 and how they've changed in the general market, in the corporate book, which is the portfolio that you would sit in if you're with a general insurer, compared with Unimutual. And you can see for the portfolio over time that we have outperformed the market in that. The gap between those two lines is pretty much money that this portfolio has saved. Now, not everyone's line will follow the blue line. Some members have changed their retention, some members have had a frequency of claims, they've changed their risk profile. We've had some members who've got brand new CBD campuses, which changes their rate outside of that. But when you look at a portfolio view, you can see here when the question I get asked, how do I know we're competitive on price in the market? Well, that's, to me, the best we can do in the story. Because trying to benchmark rates individually is impossible. There's so many factors that go into a rate. How do you compare apples with apples? Now, I'd love to be able to sit here and say to a member, here's your rate and here's where you sit in the spectrum of rates that we offer. By the time you strip out catastrophe exposure and retention level and all the different things, well, of course, you all get back to the same rate because you've taken out all the factors that change. But when you try and compare apples with apples, it's really difficult. And anyone that promises you they can, I question the validity of that information, because if it could be done, we'd do it. We want to be transparent and share. So that's the best that we can come up with at the moment, just to show the facts of what's happened over the last decade. And we're really proud of that. Now, how can we achieve that? We don't sponsor stadiums. We don't sponsor sports teams. We don't do TV or radio ads. We don't pay profits to corporate shareholders. We don't collect insurance taxes from members. We don't pay the terrorism rates that general insurers have to do through the Australian Reinsurance Pool Corporation. We buy terrorism protection directly from London at much cheaper rates. We don't load contributions for corporate profits, and we don't do sweetheart deals to win new business. The easy thing when I'm talking to new members, prospective members, is to say, come on board and we'll cut the price to get you in the door. No. We have a policy of no cross-subsidisation. We have a policy of ensuring that any new member positively contributes to the membership. either because they bring something to the table that we can all learn from, or by having their account with us, it positively financially impacts the rest of the membership, because there's no point bringing in new members if it's going to negatively impact you. We might as well not grow at all. Growth is not a driver. So they're the reasons why the things we don't do, and they're just some of the things that contribute to our pricing. Of course, our scale allows us to get good deals in the reinsurance, our low admin costs, and we'll cover some of that in a minute. But what I would like to do is ask for your help. Today we have set up a brand new email address, mythbusting@unimutual.com.au. And what I'd encourage is, if you hear anything that you think is a bit strange or contrary to what we've said, send us an email. Yeah, let's just have the conversation. I guarantee we will acknowledge your email within 1 business day, and we'll respond within 2 business days. And if we can't, because we don't have the answer, because we've never heard that one before and we want to get the facts, well, we'll tell you how long it'll take us to get back. But I'm really keen not to stumble onto some of these things, but for this membership, just help me out, help us out. You know, when you hear something that sounds a bit weird, say, I've heard this, is it true? And if it's true, then we'll say, yes, it's true, that's the way it is. If it's not true, then we'll very quickly say, it's not true. And if I get more than 3 emails on the same topic, I'll create a fact sheet and we'll send it round so that everyone can have the detail. So that email address will be coming out in the next bulletin, so you'll have it. But we just wanted to give it a dedicated focus to enable us to be a bit more agile in addressing some of these questions that come up. Because as I said, yeah, we've got a target on our back and we know it. It happens when you have a great bunch of members that everyone, you know, wants to have a crack at, and the stories that come out aren't always true. So, any questions on that? I did say I'd break for questions through. Any questions on that side of things? Either our past performance or myths? No?
Geoff, I've just got one from the floor, not related to just what you spoke about, but prior to that. You mentioned that there is a delay in issues experienced by US, UK and Canada reaching us here in Australia. Are there any trends that are unique or confronting us before the rest of the world?
Not that we've identified. You know, when we talk to the UK and Canada in particular, and more recently the US, what's your biggest loss type? And for property, they all said the same thing. $2 plastic pipes bursting above a $10 million piece of equipment. Flexi hoses. Yeah, water damage seems to be the one that we're all seeing. So from that perspective, it's nice that we're not feeling alone here in Australia, that these are an Australian issue. We haven't identified any that are unique to us. I think from the casualty side of things, a little bit different. Yeah, Jody and Jade talked a bit about sort of the rising student grievance piece, course design piece, and that has been seen internationally. The UK ahead of us a little bit on that. We first sort of became aware of that about 12 months ago in terms of that as a rising sort of class action need. But I think because of our legal jurisdiction, because of our culture, because of our structure, we see it come out in different ways around student expectation and parent expectation. But that's probably the rising one. There's 3 universities in Australia that have had significant class actions coming forth because of courses that promise things that they couldn't deliver, or students not being able to achieve what they wanted at the end by qualifying and then not being able to run an MRI machine. Yeah, they had a degree which didn't qualify them to do the work that they wanted to do. Great, thank you to whoever asked the question. Financial sustainability. So I want to talk a little bit about risk acceptance, and again, it sort of busts a myth a little bit. I hear sometimes, oh, but we're too big for the mutual. And I actually don't know what that means in terms of we're too big for the mutual as a prospective member. Our largest limit that we offer to a member is $1.4 billion. And that's based on their need. it's based on their profile. We do that 100%, which is quite unusual. In the market, generally for accounts anything over about $500 million, you'd have what's called a subscription market. There's a leader, and then you have some other insurers who contribute with their shares to build to 100%. As somebody who protects risk, we offer it 100%. So you only have to deal with us, nice and easy. We do everything out the back in terms of lining up the support behind us to do that, with over 30 international reinsurers. We have offered over $2 billion in cover. We had a prospective member we've spoken to in the last couple of years who felt that they wanted to look at cover over $2 billion. So we arranged that, provided the quote. It wasn't needed at the end. But again, it shows that we have the ability to be able to fit to whatever our members want. And that's what we call our gross retention. It's the full limit that we offer them under the policy, based on member need. As I said, we accept the risk that some others aren't keen on taking. And it provides sort of sustainability over the long term. In terms of risk transfer, of course, when you're talking about a $1.4 billion, we don't have $1.4 billion in the bank sitting there waiting for a claim. Right? So we protect the mutual in two ways. First one is we protect the mutual against a severity loss. It's a large loss. We keep our share, all claims up to a certain level, we retain in the mutual. Anything above that goes into the reinsurers. I'm going to draw, I'm not sure whether the video will pick this up. I'm not sure where the video recorder is, to be honest, but I'll draw it and you'll see it illustratively. I won't put any words on that you need to see. But if we look at our property, you've got 1.4 billion here for property. And then the mutual retention, let's call it R. And then all this bit up here. Our 30 reinsurers from around the world with A- or better S&P security, with big balance sheets and excess capital. That's where they support us. If you look at our casualty programs, 250 million, Jade? Yes. We hold a lower retention on casualty. Again, different reinsurers, casualty reinsurers on that program. Professional liability, our retention, 30 million on that one, Jade? Yep. So you can see there, when you look at our structure, we talk about reinsurers a lot, but it sort of dawned on me that we've actually haven't taken the time to maybe share what that means. So that's what that means, is when we put out these big limits, you don't have to be concerned about whether we can afford to pay it. We've got professional reinsurers who love to support organisations, portfolios like Unimutual with $70 billion, $80 billion in assets, protected, reinsured. They love our portfolio and they're happy to jump on and protect us. And at times of large events, we pay our share and they pay their share so that you're supported, you're protected at the time. So that's the severity risk, size of risk. The next question that prospective members ask me is, well, what about if you have a frequency of losses? What if you have lots of them? So if I then take a bit of a different view, hopefully I don't have any losses of that size. But when you look at, a collection of different loss types and different retentions, all these bits down the bottom that I'm sort of crossing in blue, that's what we call the Unimutual retained losses. That's what we keep ourselves. And the second form of reinsurance protects the mutual against the aggregation of all of those losses. So what that means is we add up at the end of the year. Jamie does a great job. He tracks these reports year by year, and we add up all of the claims that fit in the Unimutual bucket. And at the end of it, we say, well, did that meet or exceed our claims budget, the money we collected to pay for claims as part of our contributions? And if it did, then we go to the reinsurers and say, can you top us up for the difference? It effectively caps our claims cost. It's called an aggregate cover. And ours is a special one because it's not just a property aggregate cover or a casualty aggregate cover, it's a cross-class cover. All of the different products we have, we add up all of the claims that we retain, and that becomes what we call our retention, and we have reinsurance protection for that. I'm going to pause there. I don't want to get into the too technical, well, I love getting into the technical. Are there any questions on that part of the equation? I think we had a microphone coming. Trace?
Thank you. You mentioned before that the mutual assesses each client individual or each member individually in terms of the rates. How does the reinsurers assess? Is it the mutual as a whole in terms of the risk profile, or is it individually?
It's two ways. The first one is they do look at our portfolio overall, so they look at the whole spreadsheet of all the assets, and then they'll make an assessment based on catastrophe exposure. They'll look at the claims history, but they will look at unique elements of it in terms of members. We get a bit of a view on, from a catastrophe perspective, what's their view on where pricing should be allocated. They do like to have a look at the risk surveys that we do. So they have access to the risk surveys that Glenn and Greg and Simon do, and they'll make their own assessment of individual members. But what we don't see is them trying to tell us, here are the terms you should put on this member. Here are the things that we think your university should have in terms of retention level or sublimits or other coverage restrictions. So they're interested to understand the underlying part of the portfolio, but they don't tell us what to do in terms of how we run our portfolio. Does that make sense? Yeah. It's really important in that because as reinsurers, they understand their role. They're not the insurer. They're not at the front line. They rely on us to do the work and to share that with them. So they're looking at a portfolio level, but absolutely they love to get down into the detail and understand individual risks and, if particular losses have happened, then why they've happened and what we're doing to address that. But they're sitting at the higher level, the strategic level, rather than getting into the detail on that. And this is the bit that I was talking about, the retained risk. So how do we know that we're retaining the right level of risk? How do we track that through? Well, we have the support of some great providers. AM Actuaries, David and Ian are here. Today they do our actuarial valuation. So they'll look through our claims history, particularly over the last 10 years, but even longer if need be, to understand, do we have the right amount of reserves? Do we have the right money to pay for the claims, which we may not pay out for 6 or 7 years? Is the reinsurance solid? How is our view of our accumulated surplus against the risk we have? I said before, we've got not only the claims, because the claims of today there'll be some claims that have happened that we haven't been told about yet, so we need to provision for that. We need to know that we've got some money aside or protection for when those claims do come in, particularly for claims that happen right at the end of the year. A number of years ago, we had a tornado go through in late October, and our reinsurance, or the member renewals 1st of November, 31 October, 1st November. So that claim really wasn't known for a little while, and then at that stage it's an early estimate, so you've got IB and ER incurred but not enough reported, and as we learn more then the claim size may grow, and then we have a risk margin. So it's a very well-worn and tested and conservative approach to how we make sure that we've got the right protection and the right funds in place. We do catastrophe modelling, and that's supported by Guy Carpenter, our reinsurance broker. They model our portfolios so that we can have conversations with the reinsurers about our exposures to natural catastrophe perils. Another myth to bust. There are some members who have natural catastrophe exposures and everyone else is subsidising them. Not true. Everybody has natural catastrophe exposures, whether it's earthquake, particularly in Perth and South Australia. There is a little bit of earthquake exposure in Sydney, for those who aren't aware, certainly some in Melbourne. Hail's just about everywhere these days, and as you'll hear from David Henderson, no relation, I'll declare that up front, no relation. Everybody has hail exposure, and it's going to get more intense. Floods, yes, that's specific, but it's addressed at each member level. So we do catastrophe model to understand the portfolio, and we also scenario model. And this is something the management team has brought to the board to say, here are some scenarios we see, and here's how our cover responds, and here are the impacts, and here are the risks to the business. So there's a lot of work spent on the risk retention piece. So what does this mean? Well, we retain some accumulated surplus. As we've mentioned, increase the last 3 years. It's now at 23.6 million. There's no reason to believe we won't have a surplus again this year. It's in excess of our regulator, ASIC's requirement of us. It's a reasonable bar. They're a regulator. They have a view of the exposure and given our design. But we also look to other models locally and internationally. And APRA gets mentioned a lot because a lot of our competitors, all of our competitors are APRA regulated for those here in Australia. So it's important that we also have a view of where we're at, and we feel comfortable where we're at in terms of our comparison to that as a benchmark. There's been a lot of discussion over the last couple of years, as we have had a growing surplus, when do we know where the target is? Because at some point members are going to say, well, when do you know enough is enough? And then what do we do beyond that? So it's important that we're having those conversations and we know what that looks like. And we also look at, as I said before, stress tests. What does that mean and what impact would it have on the surplus? Liquidity, we need the money when you need the money. We have a very conservative investment strategy. Insurance companies generally put their investments at a 70-30 mix. 70% conservative, 30% growth. We're at 80-20. We do that because A, it's important that your accumulated surplus is not lazy. It's not sitting there earning nothing. We do want to have a return on that so that we can then feed that into pricing and give you better pricing. But we want to make sure it's protected and available when you need it. So it's invested 80-20, and it's highly liquid so that if we need to pay out quickly, we do. And quite often in the event of a large claim, we love to just send money straight off. It's not unusual in a large claim for us to send $1 million straight off the next day. So here's $1 million, get started. We'll work through the process, but let's get the money out there and doing good. So the resilience wrap. Jamie, I'm not going to do a wrap, it's W-R-A-P. But where do we land in terms of the resilience? Protection's based on your need, it's tailored and it evolves with the membership. We take the risks others aren't keen on. Our reinsurance program is deliberate and designed for maximum effectiveness to ensure the reinsurers are there to pay when you need us and when we need them, but also leveraging our size for an economic price when it comes to the reinsurance part. We retain the claims and it's protected. Our costs are low. We've got a low admin cost, less than 10%. That's unheard of in the insurance industry, and it just goes to the fact that we are really conscious of where we spend members' money, and we're an economic model. We don't settle for lower quality. We ensure that we've got the right people with the right experience to do the job, but our model is low cost. We don't sponsor stadiums and sports teams and all those sorts of things. Accumulated surplus is at an all-time high, capital N. Put that one in to see if anyone would pick it up. And our portfolio is liquid. So the question is, how do we incur surpluses in this model? I'm going to draw a nice big picture, which hopefully, again, illustratively you can see. Is that black a better colour? So when you look at your contributions, there we go. you've got admin costs, you've got claims, and you've got protection costs, RI. Okay. Proportions are all wrong, so don't try and read anything into there, but it just sort of shows, admin, less than 10% cost. Protection costs came down last year, which is great. Can't tell you what's going to happen this year. Iran war has sort of thrown that into a bit of chaos. We'll see. We'll let you know as soon as we know, after we get back from our reinsurance trip, where we think things are going to start to move to. I'd like to remain optimistic that we'll have another good year, but let's see where the market goes. And the claims side, this is where the first place we incur surplus. If we have a good claims year, less than we'd budgeted for, that money that you paid for us to pay claims, we retain. It doesn't get paid out as profit, it goes into surplus to use for you. So that's the first place that the first opportunity for surplus. The second opportunity for surplus is then investment return. And this is the accumulated surplus and also the reserves that we hold, the money we hold to pay claims in the future, that we invest in an 80-20 mix. That money contributes to surplus. And then the third part then is recoveries. And this is really important because at times we have large losses. We have losses that come because of the fault of somebody else. Contractor who installed a fire hydrant incorrectly. Contractor who left the tap running. They turned the tap on and then turned the water off, fixed the problem, then left, turned the mains back on, and then the tap runs over the weekend. That's a really important part, and one that we actively pursue to ensure that we're getting back the money from those who are responsible, because at the end of the day, that comes back either to the reinsurers if they've paid the loss, and by giving them the money back, then we get better pricing because they've paid less losses. But more importantly, if it fits into that bucket that we retain, that's really important. And some of these are in the millions of dollars. So the more that we can get back because somebody else caused the problem and not your organisation, your institution, the better it becomes, and we can retain that surplus. So that's how we grow surplus. I wrote this very late the other night. We don't have surplus, accumulated surplus, but what do we do when we do? Let me unpack that. We don't have surplus, accumulated surplus. We don't have more than we need at the moment. But what happens when we get to the point where we have more than we feel we need? Now, I don't have an answer for that. There'll be times when we want to grow and keep surplus, and there'll be other times where we want to reduce that surplus to support members. I don't have an answer for that right now, fortunately, because we're not at that point. But what I'd love to do and make the commitment to is when we approach that point, and it's probably not, too distant future, next few years, I'd love to engage the membership because there's lots of different options we could take. Such as, does money go back? Do we discount premiums, contributions that year? Do we invest in some work in getting your maintenance backlogs down and supporting your facilities teams and supporting your membership that way? Or do we just hold on to it and hold on to it and invest it, and the next time the market goes hard, well, then you don't suffer the big upswing that comes in the next hard market, and bring us more back to that sort of pricing cycle rather than the big swings that the general market sees. So really exciting, point to be in, 3 or 4 years on into our 5-year strategy, that we can start thinking about what does it look like when we get to that point. But the commitment I would make, whilst I can't give an answer today, the commitment I would make is I want to engage the membership in that conversation, because I think it's an important one to have around the best way to use that, not just for today, but over the next decade, over the next 2 decades, because that's the way that your institutions think about the long term. Any questions on that? Oh, we've got one from the back.
Question, what if a recovery is made a few years down the track? How is this reflected in the Pacific members' contribution if their rate previously was higher due to the claims experience?
Yeah, that's a great question. We haven't had a lot of those scenarios, but we have had some scenarios around that. I think it's twofold. I think we would look to see what the impact was, where we could unpack it. You know, we had a scenario of that happening right in the middle of the hard market. And the difficulty we had is because it happened sort of prior to the people, Tobias and myself and the team being on board, trying to understand what had happened, what was price increase due to market and what was price increase due to claim was really difficult. I think we're in a better position these days to have a look at that and to say, well, we got the money back. If there was a price impact, then it's probably fair we should have that discussion with the member to say, your price went up because of that, we've now got the money back. The mutuals benefited from it. You should also benefit as a member on that. Recoveries are never straightforward and they're never assured, is the thing. So, whilst we will pursue them aggressively, they're never assured, but when they come in, it's great. So, yes, that should be featured and factored into pricing.
Right. Another interesting one that's a bit different. It's many of us have backup diesel generators to provide load-shedded power to critical functions in the event of a grid power outage. That is at risk if fuel rationing comes. That is at risk if fuel rationing comes in. I suppose the question is the eventual risk involved in that scenario.
Yep. And that's a risk that the sector has and that we take as well. So, I mean, if we're talking about backup diesel generators that didn't have the diesel and therefore in a loss scenario, they didn't kick in. I'd like to defer to my chief underwriter on that, but I assume we would pick that up in terms of controlled environment where it's mitigated, non-mitigated. If you've got the facilities, you've got the generator, you've got the alarms, you've got the things in place, then I would hope that you're not running or pinching the diesel out of the generators to go and do other things, that you retain the diesel in those generators to do the job that they're designed to do. So I think it's an interesting conversation. I probably don't have an answer right now, but if it's something that you want to talk to us about, we can to form a position. But I'd strongly encourage you to leave the diesel where it is at the moment in the generators. Because at the end of the day, you don't want to lose 10 years worth of research because you pinched $40 worth of diesel to do something else. Yeah, but that's the sort of risk, we're all facing and we need to think through in this environment. Okay, we're right on time, which is great. A couple of claims case studies. Very quickly, I'm not going to get into depth on those. But four that we've seen, just to give you a flavour of the sorts of things that we've seen. Some members in the room may recognise their one. I've de-identified it. But February, March 22, flood, lost $30 million damage across 8 members. And this is where I was saying earlier, we do view the accumulation of risks in and around each individual area. 4 years on, we're almost done now with the repairs. The important part of that claim is the ability for the team to talk about the build back better part to it. So it's not just a matter of, flood happened and let's go and rebuild what was there. Under your protection, you're entitled to that, but also the advice we could give to say, you want to look at the long term on this, because if it's going to happen again and again and again, you might have in the past been willing to go and, as one member said to me, if it's going to happen every 50 years, we're happy to go in and clean out and fix it all up once every 50 years. But if this is now more like a 10-year event, we've got to fix this now. This is going to become more frequent with climate change. So our advice in terms of how you build back better, build back somewhere else, take a different approach was really important in some of those claims. We had a $24.5 million fire in a sodium hydroxide tank. Big technical piece of kit that we're working through. Last year, a fire in a PC3 lab. I've learned a lot about PC2 and PC3 labs in the last couple of years at the Mutual. Nearly a $7 million fire there, but a big part of that cost is the recertification. And again, that's part of what we bring to the table because we understand these losses, that it can be a small inception loss, maybe a smoke damage, but it's the recertification process that is the costly part and the timely part. Nice thing about that claim is we could support actually setting up an existing lab that wasn't being used to get the research up and running again while we got the other lab back to spec and running. So great story there where we could sort of support the member in terms of getting up and running again, thinking a bit differently, but obviously rectifying the one that had the smoke and fire damage. We had a fire in the furnace in September 2025. I thought we were just about home last year, and then we had a fire in a furnace. So a furnace was moved between buildings, it was fired up, student left the lab, bit of metal shot out of the furnace into, I think, some Christmas decorations, people getting ready for an early Christmas, and that claim was just under $8 million. So again, I always take this as an opportunity to support members. And we've had a few opportunities to support members. But look, the news, I guess, of more recent times is that after 6 years, we've finally finalised the last of the 2020 hail claims. And massive event. I mean, you're talking 4 members impacted in that scenario. It's the largest individual loss in the higher education and research sectors. It's within the top 5, we believe, of insurance losses in Australia of all time in terms of individual accounts. And that's huge because when prospective members say, how do I know you're going to be there when I need you? The first thing I say is, well, we've got a great structure, we've got great protection, and we've got great case studies. We can now show you that we've dealt with one of Australia's largest losses over 6 years. And I acknowledge Jamie Thompson in this particularly because he was there every day for those 6 years seeing these claims through for hail. 178 damaged buildings through that period. It was massive. And every one of our reinsurers supported us on the way through and paid their share. So I'm really proud that Unimutual was able to deliver this sort of result for the sector. And what does it mean? Well, I hope you feel that you're in safe hands because over the last 35 years, as at end of financial year last year, we had incurred $999.6 million in claims for the membership. And in November, we hit our $1 billionth. That's huge. And I say for an organisation our size, I don't mean that as in we're small, but as a unique sector-specific mutual. There's not many of my peers, if any of them in Australia and internationally, who could say that they've paid $1 billion to their members over 35 years. Now, the ex-property underwriter in me starts to shake when I see numbers like that, because normally that's not a good thing. But mutuals are different, right? I'm rewarded for keeping contributions down and making sure that claims are settled. We find a way to settle your claims as best we can. It's a bit inverse to what I've been for the rest of my career. But look, great to have the hail claims now sorted in that space and that we supported all the way through. I mean, 176, 178 buildings is monstrous through that, but great that we've done it. So projects, announcements, things coming up this year. Finance modernisation, so our CFO, Kudzi, and Megan and Hannah in the finance team are modernising what we do. We're automating a lot of things. We're really taking through what was an appropriate but starting to get antiquated system around our finance and allowing us to do things in a faster way. Budgeting, tracking, looking at things like conference costs and where we're at and whether we're behind or ahead on those sorts of things. So it's a great step forward. It might not be exciting, but to us it's exciting because it's a real step forward in terms of our operational capability. Cybersecurity uplift phase 2. So we've spent a lot of time and effort uplifting our cybersecurity. I'm told by the cybersecurity people not to share too much because you're not allowed to share too much about those things. But hopefully the membership feel comforted that your data is protected and safe, and we continue that work because it's an ongoing piece, but we really want to push ahead from good to great in that space. So that's a focus for this year. Data collection review. We've taken feedback from members around data collection. We feel that our data collection process, the questions we ask, are appropriate given what we need to do and appropriate compared to our peers in the market. But we've challenged ourselves to see if we can remove more questions than we put in and try and slim things down. I think in previous years we don't ask residential colleges how many cadavers they store on site anymore. We've done away with that question. We're going to try and rationalise it a little bit more, but also appreciating that we need the information to be able to sell or do a sales job on your portfolio, to talk to our reinsurers about the quality. We need the data to support us in that. So we'll do our best to reduce those. And our goal is if we introduce a new question, we take at least one out so that we don't end up overcomplicating the process. Technology transformation. We're on the AI journey. We spent half a day at La Trobe University recently with Chanel, one of our directors. He ran a workshop with his team so that we could understand what the sector is looking, a window into the sector, what's being done in AI. We also took the opportunity to workshop what AI might mean for Unimutual. So the first part is actually in the tech transformation is about understanding our architecture, understanding how we use Microsoft to its full benefit, because we do invest in the Microsoft stack, using that to its full benefit. In terms of adoption of AI, that's further down the track, and we'll take a very considered approach on that, probably a follower approach on that. But we've got to understand our tech first. Hail resilience, I won't get into that. David Henderson will be talking to that from the cyclone testing station at James Cook Uni, just to confirm again, no relation, no conflict of interest. But that's a really exciting piece for us to be able to work with TEFMA again in a piece of work that benefits the sector and a partner within the membership to be able to deliver this piece. So our members in the future, when you do refurbishments, rebuilds, new builds, you'll be able to know what the impact of hail would do to the materials you're choosing for those constructions. Member bulletins, the distribution system we use for that, at times some members have problems with them going into spam, so we're going to ditch that system. We're going to bring in a new system that will enable our bulletins to get through, so again, you can more easily access the information from us. And the last three I will spend a few minutes on, because I've got a couple of minutes. Pricing transparency phase 2. So we started this journey in the last 3 years with our renewal presentations to share more about how your price has changed over time. And you may remember the waterfall that we do that says, here's what you paid last year for property, here's the impact of the asset valuation, here's the impact of the rates, which was mostly a reinsurance change, here's a change of retention if you decided to hold more or less risk, and here's your price for this year. So we wanted to give more transparency to the movement in pricing. What we'd like to do this year is to share with you our view based on your risk management work. Because members say, well, why should I do risk management? What benefit am I going to get? So what we're going to do is engage with you, and I'm opening a consultation from today. There'll be some information coming out in the next bulletin. I'd like to engage with the membership to understand what your ideal would be and how we present that. And then we'll take that away and see what we can do, so that when we come to renewal this year, we should be able to say, because of your completion of risk recs, because of the work you've done and the way we view you, your price would have been this, and this year it's this. I hope not to have too many conversations that your price would have been this and it's this. It shouldn't be, because there's nobody in the membership who's not pulling their weight. But I think it's a fair question when people say, well, we're at 30% and you want us to get to 50 or 60, why should I? So we're going to show that. It also is in the hope of driving a bit of a change in approach, because sometimes members do the work and forget to tell us, and they're not getting the benefit. So if we can actually show that, we went to one member a couple of weeks ago and they said, we've done that, we've done that, we've done that, we've done that, we've done that. Great, tell us. So when it comes time for pricing, we can build that in. And as a portfolio, we can tell the reinsurers, look at the great job we're doing. We've gone from here to here. We're getting into best in market sort of category, and they positively view our portfolio. The second one, large loss report, and this was something I picked up from my call in the US. I got a large loss report from over there and loved it. And one of my philosophies is, if you love something, steal it and use it. So we're going to look to produce annually a large loss report. And the idea will be, Jamie's looking at me like, I know nothing about this, so don't worry, Jamie. But we're going to produce a large loss report annually for the membership that shows de-identified information, but it shows what have we seen in the portfolio, what could have been done to reduce that, and how do we learn from that. And it's something members have been asking for a while. You know, we have looked to try and create case studies, and we will do individual case studies, on topics that are relevant and important. But I think the creation of a large loss report, we have it internally. I think it's time that we actually shared it with the membership to say, here's what we're seeing, and if you're not on the list, you will be one day. So let's try and work to learn the lessons from those losses. And then the last one is, we're now into year 4 of the strategy, and the management team and the board feel like we've substantially delivered on the 5-year strategy already. And we feel like in the last 3 years, the sectors have changed so much in research and higher education that, after this year, we might sort of be treading water for 12 months waiting for a next strategy to be delivered. So we want to bring it forward. I want to cut this one off at 4 years and say, guess what? We did in 4 years what we thought we'd do in 5, and look to our next 5-year strategy. But we want to consult with the sector around what's important to you and where we should focus. I personally don't think it'll be a revolution. I think it'll be evolution of the current strategy we've got. But I can't assume that. But I'd love to talk to members. We'd love to talk to members about your contribution to our strategy. Help us understand where you want us to focus for the next 5 years. Because it's really important that we can get that right and get started to ensure that by the time we get to 2031, 2032, we're landing exactly where you need us then. So last call for any questions. Kyle.
With respect to the price transparency piece, it will be great to be able to see the positive impact on contributions of closing out risk mitigation recommendations. Will it be possible to see what the impact potentially of closing out all recommendations might be, even a range, perhaps on our contribution at, say, this year's rates?
Yep. Great question. Without preempting where I think it'll go, the hypothesis is at the moment where we'll land is that we can show the current reduction that you're getting because of your risk management profile, and then some guidance around if you got to X% or if you did these ones, then yes, that would be the financial impact around that. That would be the long-term goal for this sort of piece of work. Yeah. And look, we understand at the end of the day, if you look at it and say as a member, well, it's going to cost me $200,000 to do this and I'm going to get back $50,000. Or think of it in payback periods. You know, I'm going to save that for the next 4 years. I've paid it off. And by the way, I've also potentially mitigated from claims occurring that are going to impact my business. But yes, that would be the intention, to show the benefit you're getting today, but also guidance to where things could be better. Because, as I said, I suspect there's a percentage of wrecks that have likely already been done that we're just not aware of, and that'd be great to help your teams get motivated to finish those off, or to say, yes, they've been done, let's get them marked off. For those that haven't been started, then let's think about how we might start them. Yeah. All right, we're pretty much at morning tea. So as a wrap, at Unimutual, the members own the mutual. We don't own the members. And you'll hear me say that a lot because we really believe it. You know, we're here because you need us and you want us to be here. So that's what we think every day. We're differently structured specifically for your needs. It doesn't make us less resilient. And you can see that financially, that through, the periods we've been through, we're actually in good shape. We're at the highest amount of accumulated surplus we've had in our 35-year history, likely to grow that this year with what we're seeing at the moment. Like everyone, we have our doubters. We have myths and rumours that persist. Please, mythbusting@unimutual.com.au, or email any of us, or email me, or ring me. But, use the line if it's helpful, or just contact us directly and let us help us to work with you on that. We're transparent. You asked for transparency in our first survey 4 years ago. We've been growing that transparency as we find opportunities. We want to be more transparent around our property pricing with respect to the work you do in risk recommendations. So again, if we could ask for your help in how we share that with you for the best benefit to support you. We'll create an annual large loss report, sharing losses from the sector and any risk management learnings so that we can all learn and improve together. And the consultation will open at some stage later this year around our next 5-year strategy, because I want to ensure that it's not developed by Unimutual for you, it's developed by Unimutual with you. Thank you.